Wonderful. So I think we're ready for this wonderful morning. Thank you so much, everyone, for joining us today. Welcome to my event with Hola with Lida. This is a monthly event of serious focus on the latest trends and insights in the world of real estate. And this morning, I'm very excited to have all of you today, especially because we will be exploring the market trends and forecasts for 2023. Each month, we will be bringing you the best and the brightest minds in the industry to share their insights and expertise with you. We will dive into the deepest, latest market trends, explore emerging investments, and also opportunities that we will provide you with the tools and knowledge that you need to make an informed decision, especially in this market. This morning, I have the pleasure to have with me today David Howell, which is our guest speaker. David is the Executive Vice President and Chief Informational Officer of our brokerage, McEnearney Associates. Thank you so much, David, for joining me this morning in this event.
My pleasure, Lida. Thanks for having me. Looking forward to it.
Thank you. Thank you, David. So first, I want to start with a welcome note. This is something that one of the quotes that I really like about this business, and is real estate cannot be lost or stolen, nor it can be carried away, purchased with common sense, paid for in full, and managed with reasonable care. It is about the safest investment in the world. And again and again and again, the data is showing this, and I'm sure like all of you that have joined me today, you know about it, and you know the importance of any real estate asset. So then that is why we are gonna talk about different things this morning. So let's go ahead and talk about some information about what has bring us to this starting year of 2023 and how we finish with 2022. So 2022 definitely was two markets, if we can call it that way. We have a starting of the year with multiple offers, home sellers some sales pretty much selling very quickly, prices rising, which all of you have experienced. And then at the end of the year, I mean, for the last Q especially, there were some withdrawn listings. They were adjusting in price from the things that we were experiencing. And also it was good for us to see more opportunities for buyers and sellers, right, David?
Yes, indeed. Absolutely.
Wonderful. Yes, yes. And also, anyway, for 2022, the supply was relatively low. The interest rates, they were close to the 7%. And that was especially what really caused one of the things why at the end of the year, some of the things, I mean, we can say that it is slowed down, but it just depends in the different markets and also in the different properties. So that is one thing that also we want to mention. And also another thing that I want to bring into this presentation today was the increase in rent that we faced during last year, which was impacted by the inflation, different reasons for demographics, and also for the rising, in prices for homes, which then sometimes people, they were just thinking about more on continuing renting than having the opportunity to buy. Anything else that you wanted to share with us, David, for last year?
Yeah, I think you summed it up very well. The year started with interest rates close to 3%. They ended with rates close to 7%. And when you have that wildest swing in interest rates, it certainly has an impact on affordability and therefore has an impact on demand. And so we saw particularly the second half of the year, just fewer buyers in the market because homes were more expensive to purchase because of the rising interest rates.
Right, right. So, pretty much as you just mentioned, for 2022, then the interest rates grow and they just increase. But one thing that I wanted to share with you and then with all of you is some information from the Fed. So actually, even like for us, it seems that the 6% and 7% is still high. Historically, we are still in the lowest rates. So actually, this is something that we are going to start experiencing more like into the 5, into the 6, because I mean, things that we saw in the 2020-21, that was like atypical. But now, if we compare, I mean, the rates, and you have seen, I mean, according to different recessions and also how it was in 1980, when it was close to the 18s, that is something very different from the market that we have today, with interest rates like close to 6%. So that is just something to take into consideration. Another thing that also is important for me to bring into this conversation today is the unemployment rate. So compared to different years and also to 2020, we are still in the lowest. And that is also one of the things that is just driving economy, and why this is going to be different from different recessions that we have experienced recently. So still, we have a very, very strong economy that is just driving, I mean, just things to continue flowing. So then this is one macroeconomic factor that is very important to take into consideration as well. And of course, one of the topics that we have here for the past year and a half is the inflation. So absolutely, I mean, things have been more expensive. I mean, just compared to previous years, we are in one of the highest. But the Fed has been like pretty much continuing controlling, and that is why the interest rates have been raising. But at the end, this is also one of the reasons why we are experiencing this market, because the market that we are facing right now is highly sensitive to the interest rates, and that is completely correlated with the fact with the inflation. So then the way how the Fed has been trying to control this is just raising interest rates. We're gonna see until when, we don't know. And then it just pretty much depends, and we just have to go according to how the market reacts. Every time that we have a Fed meeting, what happened and how also the market behaves. So from the real estate market point of view, this is a chart that I wanted to share with you that is from Bright, which is our MLS that most of you are familiar with, where pretty much all the listings are published. So here it just shows the different home sales from each year. I mean, 2020, 2021, 2019, 2018, 2022. So then if you can see for 2022, of course, I mean, 2020 and 2021, they were different years, but 2019 and 2018 and 2022, you have started like seeing very things that are similar, of course, because of the increment in interest rates. So we just saw like a dip in the curve for the last year that we were just sharing. So apart from interest rate, also we are experiencing low inventory, and that is also causing that home sales, I mean, this curve is just pretty much getting lower.
Lida, can I add one other thing to that?
Yes,
Front?
please.
I'll probably talk about this a little bit later as well too, but as you correctly stated, 2020 and 2021 were really the aberrational years because of the impact of COVID as we were coming out of COVID. And as this chart clearly shows, the 2022 sales, and we're seeing it early in this year as well too, are tracking a little bit below 2018 and 19. But what this chart doesn't show is that our listing inventory today is about 40% less than it was in the equivalent times in 2018 and 19. So even though it is a smaller market in terms of overall activity, it's still a very tight market in terms of supply.
Yes, thank you, David, for sharing that. So that is very important, I mean, for all of you to know, I mean, especially, I mean, that number of 40% less inventory. So, I mean, that is a dramatically change. And then also that is the reason why we are seeing this number and the graph reflected that way. So one of the things that also we like to talk is about rents from an investor perspective and also from a home buyer. Like, what is that decision, right? I mean, from the home buyer decided, Lida, I mean, we want to buy the property, or shall we continue renting? And also from an investor perspective, what are the numbers are showing? If I invest in this property, what is the rental that I'm going to be expecting? So, I mean, for sure, 2022, it was a year that the asking rents, they increase, not only because inflation, but also for the low inventory that we had. People, they just need to find homes, and then that was an opportunity for, I mean, a lot of people just to get into continue renting or just finding a new home instead of buying to rent. For this year, and maybe David, we can share some information. Maybe we have seen that, I mean, rents have not been increasing as much as previous years, right?
Correct. Correct.
Yeah. So then let's say that things have been like starting to flat in the asking rents. Just, I mean, for you to know that is an information. And also here, we just have like a comparative of like nationwide, what has been the trend and also the behavior of the rents in different markets. Like for example, California is very comparable to markets like in the Washington DC metro area, where things were pretty much the change was 10 to 19% compared to other markets like Southern California, which things were a little bit higher.
Absolutely. And Lida, if I don't mind, if you don't mind, I'll just add one other thing as well too. And this holds true for our sale market as well. Our Washington metropolitan region holds up very well, and it is generally a pretty stable environment. Our highs are never as high as some of the high flyers, and we're going to talk about this later in the presentation as well too. And our lows are never as low when markets shift. So ultimately, this boils down to people's ability to afford a place to live, whether they're buying or renting. And when rents get too high or prices get too high, demand pulls back, and that's how markets balance. That's just basic economics. So, Lida, you're absolutely correct. The upward pressure on rental prices, in much the same fashion, the upward pressure on home sale prices is easing.
Yes. And that we just wanted to present this information because it's important, like what happened last year, how we finished in 2022, which like I feel sometimes that it was like long time, but actually it was just 2 months ago, and why we are experiencing the behavior that we're going to show to you in this, I mean, pretty much 2 months that we have of to 2023. So what are the causes? What are the macroeconomic factors that are just, I mean, changing the things? What are the drivers in this economy? So then we can know exactly how to move strategically according to different cases, according to what you're looking for, if it is a buying, if it is to sell, or if it is to invest. So that's pretty much it. So anyway, I mean, through this presentation, we're going to be sharing a wide range of data-driven insights, strategies that we're going to help you, I mean, just understand a little bit more and about what is changing in the market. We're going to explore inflation, economic factors, and things that are really impacting the real estate from the macro and also from the micro level. So then you're going to have the tools and knowledge to be informed for any type of investment that you're going to have. So, I mean, this 2023 year today has been an early spring. I mean, yesterday we experienced a very nice, I mean, on Thursday, very nice weather, warm weather. And then pretty much what I'm saying is that it's completely correlated, I feel, the way how the weather has been behaving in the DC metro area compared to what we are experiencing in the real estate market. So it has been with a lot of movement where we can say, I mean, from our side, there has been multiple offers. Buyers are out there, I mean, probably because the weather is nicer, so then everyone is also planning to buy. But one thing that I'm seeing is just the behavior of all the clients, just pretty much continuing, I mean, not just staying on the side, but pretty much if you are ready and then this is the opportunity for you, and then for multiple reasons, this is the moment when you have to sell or buy, then they are ready and they are very strong on making those decisions. So just to summarize, January and February has been, buyers are not like overpaying for homes. So the market has been sensitive with interest rates and also with pricing. Supply is still relatively low. So then for anyone that has a property on the market and is pricing it well, things are going pretty fast. And also from the buyer's perspective, if maybe there was a property that it was staying on the market like from last year, and then you just have like 20, 30 days on the market, also we are having opportunity just to, submit an offer, probably to get different concessions, just have a little bit more of negotiation, which is very nice to have in this market for sure. And one other thing that I also want to mention is that with the current administration, we are seeing a lot of incentives for first-time home buyers. So recently, on Wednesday, they released a new program, which is going to be, some saving for first-time home buyers, which always is good. For you, that if it is your first home, then this is importantly just, that is not like, don't just focus on the interest rate, because actually there are outside a lot of programs that is just serving you. Any other thing that we should share for this year? That
I'll just mention one other thing that we're seeing early in the year, and I think you've summarized it extremely well. The market from the buyer's perspective is really being driven by two things. One is interest rates, and the other, as you said, is value. And buyers are very sensitive to relatively small changes in interest rates week before, because we track weekly contract activity. And week before last, when rates jumped almost a half a point in a week, there was a discernible pullback in buyer activity. When we run the numbers tomorrow night, we expect to see some of those buyers, they're coming back. So they're just very, very sensitive to rapid changes, even if the changes are fairly small in interest rates.
Yes.
Sellers have to be very attuned to that.
Exactly. So then that is why like this information and data, and to be, in touch and just knowing exactly what is happening on the market is very important now. And that is the reason why we are providing this data. Why, from our brokerage perspective, pretty much, the team is running information weekly, even like by day. We are meeting every week just to share that information on what is happening on the market. Because as David mentioned, 1 week is different from another one. So we just have to go, pretty much checking what is happening with the interest rates. But at the end, buyers are there, and also there is opportunity on the market. That is for sure something that we are seeing. So let's talk about some macro realities. So we are going to talk, and that is something that we're going to continue talking for the next year, and it's going to be interest rates. At the same time, demographic, and the other macro reality that I wanted to talk about is supply. So those three things are going to be decisive on how things are going to move for the next year. How things are going to change in the market is going to be pretty much, very, very related with what is going to happen with the interest rates. However, one of the graphics that I'm going to show to you is about demographic and why this demand is the one just making that the market is continuing to grow, and also that prices are not just gonna, plumb, right? And also with the supply, we are forecasting that we're not gonna be oversupply. And actually, we're gonna be pretty much to the demand that we have right now. The supply is gonna be, let's say, low, in the lowest, and it's not enough to pretty much cover all the demand that is out there. So let me share with you some interesting graphs that I just got. So this is from the Federal Reserve, and this is one of my favorite graphs that I wanted to share with you. So if you see, the shaded areas are the ones that have indicated US recessions. So for the past years, every time that is, what has been the behavior of the prices after every recession, it is just that prices have been going up. And we're gonna see it in different graphs for the presentation of what we are experiencing and why this is happening. So it's just like historically, and I have a lot of economics here in this room, I know. So we can see, that this trend is just continuing to happen. Probably what we have experienced, of course, is just like an adjustment of prices. It happens because of the seasonality. It happens because of what we have experienced for 2020 and 2021. But in markets as stable as David mentioned, things are gonna continue to appreciate and prices are still going to go up. So that is the message that I wanted to share with you. Apart from that, this is another graph that is very important that I share with you. So pretty much this graph, what it has is just the mortgage originations. So we also check that. We check on how many people is just applying for mortgages, how many people they are getting loans. So then we have the refinance, which is the yellow bar, and also we have the purchase, which is the blue bar. So 2021 and 2022, 20 and 2021, they were just different markets. But if you see for 2022 and 2023, they are just very, very similar to a great market that it was in 2005. So there is still mortgage originations, and we are forecasting for this year and also for the following years growth. So people is gonna continue buying, people is gonna continue getting loans, and there is like no decline on this. And of course, refinance pretty much, it will continue. I mean, it just depends case by case, but it's just that there is still growth and movement on this. So that is why this is important, just for you to see one thing and the other. Now, this is the graph that I was mentioning to you, and why sometimes when people say, oh, we're gonna have like sort of like things are gonna come down, Lida, when are the prices are gonna be less than 40%, when I'm gonna get like this great discount? Well, let me tell you, right now we are in the biggest wave of Americans on the peak of home ownership. Exactly, people of my age, 34 to 38, which are millennials, we are right now in the market of buying that house. We are in the plan. We have like a starting family, we have new kids. So then we are right now in this momentum. And if you can see both of the graphs, which one is from the census and the other one is from Moody's Analytics, it just shows that we are in the highest. And that is like the 22, 28, I mean, a little bit younger than me, but pretty much that is like the range that we are experimenting right now. So that demand is going to continue. And that demand is pretty much the reason why this market continue to grow and why the prices also continue to grow. Apart from that, if we are having this demand, then let's talk about supply and demand, right? So
Lida, can I just interject something very quickly before you go to that slide? You mind going back to the demographic slide?
Yes.
And I'm sorry to put too fine a point on this, but I'm a proud father of 4 millennials. In fact, my oldest is at the first age that millennials started, and my youngest is the last year that millennials started. And the reason I say this may be the most important slide in this entire presentation. There's a French philosopher whose name I forget that was quoted as saying, demography is destiny. And as Lida indicated, where those peak years are, we are entering a period of time with the median age of the first-time home purchaser now being 34 years. We are entering a wave where an extraordinary number, in fact, the highest cohort in American history of people entering that prime home buying year. So we're not naively suggesting that prices always go up, because they don't. We know this can be a cyclical business, but we have an enormous bow wave of demographic support of buyers coming into the market nationally in numbers that we have never seen before. And that gives us great encouragement for why we believe there is a fundamentally strong foundation to home prices.
Right. And I mean, it's great, David, that you add that. And on top of that, also we have a generation of baby boomers very strong. Baby boomers that have accumulated sufficient wealth, and you're gonna see that in a graph that I'm gonna share later, which, I mean, most of them, they are like free and clear. And apart from all the appreciation that the homes have, they are willing, I mean, at this moment, they have enough money and they have built enough wealth, which is also something that is very, let's say, inspirational for this generation, how now the baby boomers have built so much wealth that they can also, I mean, they are just thinking on, I mean, they just diversify pretty much their portfolio on like, or downsizing, getting another home, helping their children. We are seeing a lot of, I mean, our clients helping their children buying a home or just participating in the purchase of it. So, I mean, I love just the thing that you just mentioned. I mean, just that demographics is destiny, right?
You bet.
Yeah, exactly. So, and then this graph that is the reason why I wanted to share it with you. So apart from that, so we have a very strong demand, but what is happening on the other side with the supply? So homes that are currently under construction, so things are just slowing, like growing. And I think that builders have noticed that it's important, I mean, just to continue building because of the demand that they have. And they also have this information that, I mean, there is an important, let's say, clientele for their homes, which was different. I mean, sometimes when people say, oh no, I mean, this is something that how is going to be comparable to 2008. So this is something that I mean, took from the Joint Center of Housing Studies at the Harvard University. And pretty much what is showing is that when it was 2008, the demand was not there and they were just overbuilding. So then there were too much inventory and the demand was not there. So it was, I mean, they just did the formula opposite. In this time, then the demand is there. And I mean, that is why also builders are saying that they are the ones having their homes. So then they are continuing to build. On the other side, from our side, also we have supply of homes that have reached on the lows. And that is something that we have talked about. We finished like that 2022, and also this year, the inventory has been also low. So that is the reason why if there is a lot of demand and then you don't have enough supply, then, I mean, for simple fundamentals of economics, then prices, I mean, at least they have to stay or they are not gonna drop because, like, for example, in a neighborhood, you only have like 2 listings and then you have 15 buyers planning to buy in that neighborhood. So, I mean, it's just sellers and buyers. That's pretty much it, what we wanted to share there. This is exactly, I mean, another graph that it also shows same things that I have been sharing with you, 2008 compared to this year, and also the lower inventory that we are having right now. In addition to that, another graph that I wanted to share with you, and that is also related with the thing that we mentioned about how much wealth I mean, owners have built. It just says, I mean, for any one of my clients, which is thinking to continue renting, to continue owning, to buy a second property, to continue investing, it's just the net worth of owners compared to people that is renting. So, I mean, the graphic speaks by itself. And then it just says, I mean, the importance of home ownership, especially, I mean, in this market, and how it just helps you from an owner perspective. So now let's get into the Washington market, and we're gonna share with you what has happened, especially from a microeconomic aspect and local aspect. What are we seeing? What are the different numbers? What is the data? So just to start, pretty much, I mean, in our company, the brokerage and then the team, we provide to our clients, and then they put together all the data and information of like all the different counties that we have, also sales, and then we have different factors and that is very helpful just to make a decision for you and how strategically you can move according to the different, I mean, case by case, how you want to move, if you want to buy, if you want to sell, it just depends. So let me show you something. So pretty much home demand index, it just shows like how many people and what is like demand pretty much that the buyer interest that is in the market. So comparable to 2021, demand has been a little bit low just because of interest rates. That is pretty much the case. But if you see comparable to how we finished last year, this year our demand is growing, right, David?
Yes, it is. And that's historically the case as well, too, Lida. December tends to be the lowest month of the year in terms of contract activity, which is the best expression of buyer demand. And the market tends to rebound in January. But the rebound this year is not going to be comparable to the same time last year because interest rates are 3 full points higher than they were a year ago.
Right, right. So maybe, David, if you can help me with this, just sharing, I mean, these 4 bullet points about like what the report that we just published on the report for January and also February for this year.
Well, again, this is largely driven by interest rates, as we've already discussed, probably more than you all care to hear. There is still roughly 1,000 homes going under contract every week in the metropolitan area. That's less than last year, but it's by no means that buyers have gone away. I think part of what drove Lida's desire to have this discussion this morning is there's so much national media out there about how awful the housing market is. And at least in this metropolitan area, it's not. The second bullet point is probably something you've never heard of before, but we kind of invented it more of an internal way. All the urgency index is the percentage of homes that are going under contract every month that were on the market for 30 days or less. And so when that percentage is higher, it indicates a much hotter market. And when it's lower, it simply means that buyers don't feel compelled to act as quickly. So as Lida indicated here, the urgency index was a little over 40%, which is not bad, but it's down 11 points from what it was this time last year. Again, not surprising given what's happened with interest rates. Inventory's up a bit compared to this time last year, but as I know I've already mentioned, it is way down compared to comparable times in 2017, 18, 19. And so the increase in inventory largely has more to do with the fact that homes are simply staying on the market longer, that they're not coming off as active inventory as quickly as they used to. And although I don't know, we don't have a bullet point on this, it's also amazing that even though there is less buyer activity, there is dramatically less new seller activity. Through the first 7 weeks of 2023, there's about almost 50% fewer new listings that have come on the market. And all of that contributes to a continuing tight supply.
Yeah. Yeah. So then, I mean, with the demand and the supply, so pretty much we wanted to share with you how each county is behaving. And I'm going to share with you important data for each of it. Because I know that some of you are thinking on selling, buying, or investing in DC, Montgomery County, Bethesda, North Bethesda, Rockville, in Fairfax, Arlington, Virginia, Alexandria, and also Prince George County. And also because you want to have like a big picture overall of what is happening in the DC metro area. Some of you also, you said, Lida, it's better just that I invest in DC or Montgomery County, or either I buy a property in Fairfax. So let's dive into the numbers and also in the data. So then you have like a big picture of what is happening. And also we're gonna talk about not only like by price. So then pretty much we divide the report like by price range, but at the same time by type of property. So we're gonna see condos, co-ops, at the same time single families, and also detached homes. So then you will have like a full picture of what is happening in each of the counties. No worries about taking like screenshots, things like that, because at the end, you're gonna have also this presentation with you. And at the same time, you're gonna have the full report. So just bear with me. And of course, if there is like something in specific, then we can talk like on a one-on-one. But for now, I wanted to present this because I just like that you see everything in one chart, so then you can compare. So pretty much for the Washington, DC metro area, as David mentioned, let's say overall, we are seeing less inventory in like the 5 counties. I mean, Loudoun County, Northern Virginia, Prince George, Montgomery, and also Washington, D.C. But one of the things that also I wanted to mention and things that you are going to see is, for example, the average sales price. So one thing is that even if we have like the tight inventory and also we have the demand, for example, for the sales price, the reduction has been only like 0.5%, for example, in the DC metro area. So it just shows also how strong, I mean, the market is. For example, in Montgomery County, even it grew, like it went up 10.5%. The average sales price was 586, and then this year now is 647. So then for those of you, and now I go again back to my chart where it just says that, I mean, prices continue rising, and especially in this market, then here the data also shows to you exactly the same information. The same from Prince George County, and then exactly the same thing for Northern Virginia, and pretty much the same thing for Loudoun County. So all of them, right, David? I mean,
Yep.
Prices go up.
And Lida, and I know you'll get into more details on this in some subsequent slides, but DC is a bit of the outlier in our metropolitan area. It is closer to a balanced market than the suburban markets are. And the reason it looks like that is largely due to the condo and co-op market, which is about 60% of all sale side transactions in DC. The condo market, particularly for buildings that are older with very few amenities, people after COVID are looking for a different kind of lifestyle than exists in those older units. And so that is having a moderating effect on prices on average in DC, but row homes and detached homes are actually faring pretty well.
Yes, yes. And then, I mean, when we were seeing, like, I remember for like the past year, when we were seeing like absorption rate and all of that and inventory in the condos in Washington, D.C., I remember that when I was having the discussion with my clients, we were always seeing like that opportunity, like also from an investment perspective, right? Because they were like quite, I mean, inventory out there. And then also opportunities like for you to get into those properties. So those are the things that with this information, you will be able like to check, and also that we can strategize according to your needs. So this is like a full information, and then of course we can go deeply into that. But another thing that I wanted to check here with you is the urgency index, right? So I mean, pretty much it just says, I mean, the measure of percentage of homes going under contract, and then David also shared with you. But pretty much if you see, for example, I mean, all of them, it just seems that it has reduced a little bit, but as David mentioned, it doesn't mean that it's bad. Having an urgency index of like 40%, 58%, 58, I mean, that is like a lot. I mean, it's like a high index, and it's just showing that the demand is there, and then that people is getting under contract, and that things are moving. And you're gonna see, for example, in days on the market as well. I mean, things are just taking a little bit more, but also remember that we are checking here a seasonality. With some of the properties, they just stay during the holiday season, and that is the reason why this number is just showing a little bit higher. Once we show probably like in March or April numbers, then it's going to be a good comparable on things, how, like, for example, from a days under contract, how things have changed. So that is one of the things that I wanted to share. Another thing that also, David, is important for the audience to know is about the months of supply. So what is, I mean, why we include that months of supply here in this information?
Sure. And although there's no hard and fast rule on this, most housing economists consider a 4 to 6 month supply of homes to be a balanced market where there's not much, if any, upward pressure on home prices. And I know the size of the screen is hard for anybody to see, but the greatest supply in the metropolitan area is Washington, D.C., which I think is at 2.6 months. Yes. So even though DC's market is softer than the suburban markets, it is still in a range that most housing economists consider to be a seller's market. It's just not as intense a seller's market. In the suburban markets, every one of them is hovering right near a 1 month supply. And although that's a good bit higher than it was a year ago. It's still a 1 month supply. And by any measure, that's a seller's market. And to give some further context to this, because we've been doing this for a while, if we were to look at the same numbers during the Great Recession in 2007, 2008, 2009, supply crept up over a year in most of our jurisdictions. So despite the fact that we all know that we're in an environment where we may be teetering on the verge of a national recession, the housing market today bears zero resemblance in any way to what we were seeing even in the early days and during the middle of the Great Recession. This is still a strong market. It's just not as strong as it was in the immediate aftermath of COVID.
Yeah. So, I mean, imagine, for example, I mean, what just David mentioned, I mean, months of supply of like a year. Here we're having 1 month. So, I mean, it just shows inventory demand. The numbers speak by itself. And also, I mean, whatever, I mean, if you are saying, oh, maybe I should wait, maybe things are just staying in the market longer. If I see this home, I should wait, I mean, to see what happened next month. Things are moving fast. And things are, I mean, just the fact that probably some homes, they are not, I mean, we were used to have like days on the market 1 day. Now, at least you have the opportunity to see the house a little bit more, but it doesn't mean that you just have to wait, because if the house is priced correctly, it just goes. And then that is just a fact. So this is also a very interesting average sales price graph. And it is, again, the same information that we have been sharing with you. So the price is still like very strong. So if you are thinking on investing in this area, which I think that some of you were like, probably you're from outside, or you are just saying, I mean, should I continue investing in the Washington, D.C. area? So it just shows, I mean, how strong the market is. So if you can see, I mean, there is just 1 point, which is the red, that is the 2023. And the prices are starting exactly at the same as it finished pretty much last year. So it is just sharing the information that then prices are continuing, and then they are just staying there, right? And if you can see, comparable to all the different years, things have increased. I mean, each year things have just going up and up, which is like, I mean, very interesting to see from an investor perspective, as you know that at least your investment is going to be safe in this market with these prices. One of the other information that also we provide is the fully available listings. So then this is just pretty much all the inventory that is available, and then it is just divided by price range. So then if you see most of the inventory, let's say, it is in the 500 to the 800s, which, I mean, is pretty much the average price that is right now in the DC metro area. So 34.9% of all homes on the market, they have had at least one price reduction, just because it moved from last year to this year. So if they want to just put it on the market and they want to sell it, then it just have that one price reduction. And also the other thing that we were mentioning, that is the months of supply. So you can see that depending on the range of the property, the price range of the property, then things have, I mean, the months of supply is just higher. So for example, in properties that are 1.5, then things are staying a little bit longer on the market. And then we have more inventory, I mean, per se, let's say. But comparable to, for example, condos, as David was mentioning, which is like pretty much all the properties that are in the range of 0 to 300, which is like some studios that you see, which sometimes, I mean, this inventory are like studios that sometimes they have like a high condo fees or high co-op. So then that is why the months of supply, they are around like 3 months. And they just take a little bit more. So that also affects, I mean, the number that is just showing there. The other graph that also we wanted to show, and then this is the relationship of the price compared to the list price and days on the market. So one of the things that we have mentioned throughout the presentation is how the market is very sensitive with the price. And then if you price correctly, everything is going to be good. I mean, from the seller's perspective, but the longer that it is, I mean, higher discount you just have to take. So for example, I mean, properties that they are, I mean, that they price correctly, they go in like 0 to 7 days, which, I mean, that is very, very interesting. And then homes settling in January of 2023 that received contracts in the first week, they were above 0.45% of the list price. So then it just shows, and pretty much what we have been sharing with you, the multiple offers on properties that we have seen that they show well, and also that, I mean, that they are priced correctly. On the other hand, from a buyer perspective, if you want to wait, or maybe if you say, Lida, probably let's check properties that are like, that have been staying on the market for more days. So then we can have a little bit more of negotiation, or maybe they could be like some price discounts. So always we check properties that they have been on the market for more, let's say, than 20 days. So there are different reasons why they are still on the market. It doesn't mean that the property is bad. Probably it's like the photos, maybe the price was incorrectly, maybe the buyer just decided not to continue with the offer. So different reasons why this happened, but then there is opportunity for both sides. Just, I mean, to share with you. And in addition to that, also the average numbers on the market. So this is very, very important because, I mean, we are just seeing, and also is a trend that properties are taking a little bit longer, but also it is related with the seasonality. But in units that, for example, in the properties that are 1.5 million higher, actually days on the market have reduced. So now let's go to one of our favorite rates, which is the absorption rate. So David, let's share with the audience what is the absorption rate and why it's important for us to show this and for them to take a look at this information.
Thanks, Lida. As the name suggests, the absorption rate is simply the pace at which the market is absorbing the available inventory. And absorbing in this case is properties going under contract. And we use some general rules of thumb of how we characterize markets. Generally speaking, when we see absorption rates of 30% or higher, we consider that to be a seller's market. And in all of our suburban markets, in all three property categories, again, that's condo, co-op, attached and detached homes, absorption rates are above 30% in all the price ranges, which is pretty remarkable. Having said that, they're not as high as they were this time last year for all the reasons that we've talked about. So again, we know it's hard to see the specific numbers here, but you see that last column there. If you see a red number, that means that the absorption rate is lower than it was this time last year. And you can see across the board, it is lower than it was this time last year. However, in all three property types and generally speaking across all price categories, we are in the upper end of a balanced market. So even though the DC market itself is softer than the suburban markets, it's still overall a pretty healthy market. It's just not the extreme sellers market that we saw over the last 2.5 years.
Right,
so,
right.
So as a wrap up, if you look at condo and co-op there, the overall absorption rate is, I think that's what, 27%. For attached homes, it's 29%. And for detached homes, it's 27%. So all of those are very close to what we consider to be the threshold for a seller's market. The market is still pretty decent.
Yeah. So pretty much, I mean, when it's seller's market, we define that is everything, let's say above 30%, right, David?
Yep.
And then anything that it will be like lower than 20% will be like a buyer's market. But I mean, there are different things to take into consideration. So if you see here, it is just, I mean, adjusting to a balanced market. So then that is why I have mentioned, I mean, according to the price range, according to the type of property, it just depends where, I mean, where is the opportunity. If you're planning to buy, if you're planning to list, then pretty much we say, how many condos are there? My price range is going to be in the 750. There are listings 107. So then I have competition of 107 properties, and then 39 are already like under contract. The absorption rate is 26. So then it seems that there's going to be a fair negotiation between both sides. There's going to be buyers that probably they're going to ask for things, but also from the seller's perspective, you will be able also to get probably different offers if that is the case, or just to get a solid offer, which is something that always we look for. So that is
Washington, D.C. metro area.
Lida, can I just add one other thing? And Lida's so adept at understanding all of this. This is kind of the summary of absorption rates. We take a very granular look at this by zip code and by price range and by property type. And we really take it into very small slices by price range as well, too. And we can see where the differences are. If you're looking at condos in DC between $400,000 and $500,000, the absorption rate may be very different between $500,000 and $600,000. So this is part of the analysis that we try and go through with each of our clients to help them make informed decisions, whether they're buyers or sellers.
Exactly. And then that is the reason why always we check these absorption rates, because for me, this is key on how we're going to strategize according to each case. So now let's talk about Montgomery County, which that is something that David was saying. Comparable to Washington, D.C., everyone that is there that is like checking like Bethesda, Chevy Chase, Rockville, Gaithersburg. So how Montgomery County is behaving. So in the condo and co-op market, pretty much it's more like the condo market, you have like absorption rate of 50.9%. That is the average. And basically, the one, especially the range the price range of condos between 500 to 750 is the one, pretty much one of the highest. So then if you see inventory is low, especially in like high price condos, so then that is also pretty much like a very seller's market. On the other hand, attached home, which is like townhomes, we have like a balanced marketing properties that are like 1 million to 1.5, but properties that are like townhomes in the 300 to 500, which is like let's say most of the properties that people is looking for, and also the demand is there for properties from 300 to 500 for attached homes. The absorption rate is 63.5, and properties that are under 300, that is 90.9, because there is only one listing in that price range. So then it just shows, either that we need I know for a fact that there is a high demand on that price range, especially in this market of Montgomery County, but it just shows, exactly if you are thinking, of buying a property there, then definitely it's going to be a seller's market. It just depends on the property, but that is exactly what the data is showing. And with single family homes, for sure. In suburban, after COVID, that was like completely the trend. It was just that people, they were looking for more space, and that is why most of the people, they moved to the county. So then it's like basically, also seller's market, very, very low inventory in the county. Things that are under 300, there is like pretty much nothing. And then properties, it just shows, absorption rates of 64 and 55, which is completely different from the Washington, D.C. metro area. Now, for all my clients that are like in Fairfax, Arlington, now let's check what are we seeing in the Northern Virginia area. So from the condo market, we are seeing also seller's market, but if you see here, and that is why it's very, very, very important that we take into consideration and pay attention to each of the price ranges, because condos that are 1 million to 1.5, they are going to be in the buyer's market. So then if you see it's 13.8%, there are 25 listings. So then it shows, if that is something that you want to get into, Arlington, Roslyn, where you have, those type of properties, then there is an opportunity, if that is something that you're looking for. Or if you're planning to list, then you know that probably we have to price it correctly. Now from the attached homes, so definitely, nothing under the 300. And this is like a very, very high, seller's market, especially like in the 500 range. So it's like 82%. So then completely like a seller's market. And from the single family homes, so then you can see that everything that is below 1 million is going to be almost like a very high seller's market, which is like 90%, 65%. But we still have, let's say, a little bit more of balance in properties that are 1.5 million. And I think that is something that we have been seeing a buyer's market, I mean, in properties that are above 1.5, right, David?
Yes, absolutely.
Yeah. So then, I mean, it's very clear here. You have listings that are 288 listings. So if you're planning to buy, or you're saying, Lida, this is the year where I am, all my kids, I mean, we are growing, we are a big family, where should be the place where we can go? Well, here, like, it's just showing that in the Northern Virginia area, probably we're going to have opportunities as we have, I mean, let's say a more balanced market, let's say. So just to share, I mean, comparable to how it closed last week, because this is a report that the MLS, it just report to us by the end of each week. So it reports to us every Sunday. Compared to a week ago, things have, I mean, increased, more contract sales. And as we mentioned in the beginning, because the past week, let's say the past 2 weeks, because of the interest rates, things were like, the interest rates were like around 6%. So then they were like very close. I mean, there were more contracts and there were more demand and more activity into it. And this number of 15 days on the market, that is something that is very, very interesting. So compared to a week ago, it's not that things have changed, but if you see, I mean, this market is also moving pretty fast. I mean, 15 days, we have come, I mean, like 3 years ago, probably the median days on the market was probably 35 days. But now we are seeing median days on the market of 15 days on the market. And also we are seeing more showings, more inventories. So let's say that we're gonna see like gradually an increase throughout the year, but it just depends on how our different macroeconomic factors, how it behave. And that is just going to determine how things are gonna move. So I know that most of you were like, Lida, tell me more about like how Washington, D.C. is different from other markets and why Washington, D.C. So probably David can share with us a little bit more about this.
Yeah, and thank you, Lida, because it's, as we know, we've said that when we see national media that talk about the national housing market, I think everybody on this call knows there's no such thing as a national housing market. You can look at the numbers overall, and I'm sitting here in McLean looking outside that it's snowing, forgive the tired analogy. But if I told you that the average temperature in the United States today was 65 degrees, it doesn't tell me anything about whether it's snowing in McLean or warm in Miami. So with that context, every market is different. And as Lida's just gone through in great detail, even within our metropolitan area, the market conditions can be very different. So when you see, or if you see articles that talk about real challenges in the market, there are some places in this country that are challenged. Taking a look at Austin. I grew up in San Antonio, Texas, so I'm very familiar with Austin. Austin has 260% more listings on the market today than they did this time last year. That's an enormous increase. Looking down the list a little bit, Dallas, almost 3 times as many listings. Denver, 163%. Las Vegas, 118%. Phoenix, 190%. So you look down at the bottom there, although Washington, D.C.'s inventory is up a bit compared to this time last year, there are other places in the country that because of this significant increase in inventory, there's going to be less upward pressure on home prices. So the only note I would add is when you see articles that talk about national housing statistics, it's great to look at them, but don't interpret that has anything to do with what a market is in this area or in New York or in Chicago or LA, because everything's different.
Yeah, everything is different. And I just love how always you have mentioned to us that, nationwide, we can never say like it is exactly the same, right? Because it's the same thing as the weather. So that is the message that we wanted to share that. And with all this information that you have seen and also with the market, we are just going like hyper local with this information. You are getting information on what is happening in the county. You're getting information on like different price ranges, type of properties. So then you have, with this information, our expectation is that you have an overall like big picture of what is happening on the market. And then later we can go in deep according to the zip code, according to the area, according to the type of property that you're thinking or that you have. So that's the message that we wanted to share. So what is our 2023 market forecast? So pretty much while we look ahead, and we are just sharing, pretty much this forecast based on the data. We are a data-driven team, and that is why we love this information and why we share this information with you. So definitely this is going to be an interest rate sensitive market. Homes prices are going to still appreciating. So if you're planning to buy, invest, then things are going to start anyway. Things are going to appreciate. Buyers will have more leverage, but at the same time, sellers will have opportunities because there is low inventory, and then you have a very strong pool of buyers out there. Inventories will remain relatively low. Buyer interest is going to remain solid because there are buyers out there and they have been waiting. So then every time there is a house coming, then that is the opportunity that is coming. And at the end, pricing will be very important. So then either that you're writing an offer or just putting a property on the market is going to be sensitive on that. Any other thing that you would like to add to this, David?
No, I think you're absolutely correct. It is still overall towards the lower end of a seller's market, and pricing is the most critical thing for sellers. Price it right and the market will reward you. Price it too high and buyers will pass it by because they are so sensitive to interest rates and value. Exactly.
So as I mentioned in the beginning, this is I follow Odetta Kushi, which is the Deputy Chief Economist from the First American Financial Corporation. And in one of the latest reports that she had, this previous week, pretty much she shared that with higher mortgage rates from selling, free and clear homeowners may hold the key of unlocking so much supply that we have today. So for anyone that has, pretty much this is a eye-opening. So 42 of owned homes are free and clear because of the appreciation and also all the things that we mentioned, baby boomers, all of that. So then 42%, they are just free and clear. They don't have any mortgage on the properties. So if you are seeing real estate as a way, how to build wealth, this graph, is just showing and speaking and why, this is one of the safest, let's say, ways how to build wealth for you. So the key takeaways of this call is pretty much be prepared, buyers, sellers, and investor, be prepared to act. So as David mentioned, things have been very sensitive, and any change, any move that you see in the interest rates, either demand is going to come and then it's going to be like a lot of activity from buyers. But at the same time, from the investor perspective, if you are a cash investor, also you have opportunity as, if interest go up, then probably the buyer pool is not going to be too much. And then you also have opportunity to get into that. So definitely be prepared. Pricing, as David mentioned, pricing is going to be the key also in this market. Use data. This is available to you, all the market reports, the insights, get, together with us. And also, so then you have more information about what is happening in the market. And then for sure, demographics and inventory are the macro realities. 2013 is not 2008 with the information that we share of the demographic demand and also with the low inventory. We are expecting that things are just going to continue growing in a different pace from the past 2 years, but for sure, things are, we are not seeing things just to collapse. We are seeing that things are going to grow, and they're going to grow in a very healthy way, which is something that we are looking for. So just to mention to all of you, we have a lot of resources that are available to you. We have our monthly market reports that are, you just have to sign up and then they will be available to you. We have our one-on-one consultations. We have our monthly events that we do, with key speakers, experts in this area like David that is joining us today. Also, in our monthly newsletter, we are sharing the market insights, what is happening. Some of you also, you have requested, like I shared with you according to your market, weekly updates. So that is something that I also share, curated data and expert partners. So things that you say, Lida, I'm planning to invest, I'm planning to buy. So also we have expert partners along our side to just help you throughout this process that you're thinking of buying, selling, or investing. So I'm going to open the room for any questions that you have for David or myself, or any comments that you would like to share with us. You feel free to raise your hand, or then just open. You can ask a question in the chat box.
I think it's safe to say this is an overwhelming amount of information, and it's a lot for people to digest.
Yes, for sure. So I am getting a question from Luz, and Luz is just asking us that she would like to know more about, like, if today we wanted to invest in Washington, D.C. area, which should be the property and where do we see more opportunity in?
Well, I'll take a crack at that. And there's no ready, easy answer to this. I think it depends on whether your horizon is more short-term than long-term. But the property category that would concern me the most about making an investment in is the one that's the most challenged right now, which is the condos and co-ops in older buildings in DC. They are, I think, very reliable from a rental standpoint, but from an appreciation standpoint, because of the age of the building, of the buildings, and the likelihood that fees will continue to go up to maintain those older buildings, and particularly units with no outdoor space and buildings with no amenities. Those are the ones that I think are going to be the most challenged to have significant appreciation rates, because it's just simply not the kind of housing that people are looking for right now.
Right.
But almost every other category, I think, represents a real opportunity for investors. And Lida, as you said, I think the opportunity for investors that are either well-financed or have cash is when interest rates tick up, and we anticipate there's going to continue to be volatility in interest rates. I think the opportunity for investors are in those discrete windows of opportunity when interest rates tick up, and buyers that are having to buy contingent on financing or pulling back. That's an opportunity for investors to come in. And those are literally shifts on a day-to-day and week-to-week basis. Lida, does that make sense to you?
Yes. And then just to add to that, as it is very important just to check, the type of property, what the demand is there. So then people also, we will see that. What are the trends? What the demand is asking for? And that is always the type of conversation that we have. What are the things that you're looking for? So then that just helps during the conversation. So I know that I have, I think, Juan, you raise your hand. So I'm gonna let you talk, and so then you can ask the question. You're on.
Thank you, Lida. It was the kind of the same question that the last person asked, and I wanted to say thanks for the information. And I wanted to ask as well if there's like any forecast for a housing market recession, like for this year, or like as we are seeing the numbers, is growing, right?
Lida, I'll take a crack at that if you don't mind. And Juan, thank you for the question. I'm not an economist by any stretch of the imagination. I have followed the DC market for DC metro market for now 38 years. And a couple of things. I think it's likely, given the Fed's action, and the Fed has a very difficult task in front of it to try and get inflation under control. I think most of us are anticipating that we're likely to see a national recession at some level. Going back from the mid-50s forward, as the Fed has battled inflation, and this is in no way, shape, or form a criticism of the Fed, every single time they have overshot in terms of raising the Fed funds rate and have forced us into a recession. And I actually think that's probably the objective of the Fed right now. So having said that, even if we enter into a recession, I think most economists are thinking it's going to be relatively short and not very deep. But even if it is, the DC metro area has tended to hold up very well compared to most other places in the country. And I think a lot of that has to do with the stability of employment of the federal government and all of the economic benefit that flows from that. So I'm not suggesting that it's all sunshine and roses, because it isn't. But if I were investing in any market in the country, I'd feel more comfortable about investing in the DC metro area than any place else, just because we have tended to hold up pretty well, even during periods of recession.
Yes, and also to complement what David just mentioned, Juan, I mean, that is like pretty much based on the question that you had, is why I wanted to share the information, like the macroeconomic, information, right, that we have out there. So just that, the Fed, and also we see historically, we see what is the pattern, what it, like economic, pretty much what has happened like with the previous recessions. Even if, we have like a slight recession, what is going to happen with the market, then prices are just going to go up. And then as you see, things are growing. And also apart from that, then you have the two, factors that are the demographic, and also you have the low inventory. So then it's just showing how things are going to move. If we had a different scenario of like maybe more supply and then we had like less demand, things, we will be in a different market, or I will be sharing another different pretty much information. But you have seen, pretty much the numbers and the absorption rate and what is happening, basically in each county. So that is what we are seeing. Just let's say not only the growth, but also like a balanced market. And then we just have to find for that opportunities on where, according to what you're looking for, we can get into that.
Thank you.
Sure, Juan, thanks to you. I have another question from Landre. Landre, thank you so much for joining us this morning. Landre, David is asking us, is the rental market is hot? I know they were during COVID, due to the high demand and low supply. Is this still the same? And which areas in Montgomery County are the hottest?
Sure. Well, that's a great question. I will tell you that overall, Montgomery County, both on the sales side as well as the rental side, probably has the hottest market in the region right now. Having said that, hot's a relative term. It is cooler compared to the frenzied days of COVID. And so there is, much like there is in the sale market, there's not as much upward pressure on rental prices as there was this time a year ago. And this is not specific to Montgomery County, but I know this is only one small anecdotal story, but we have a rental listing on Capitol Hill in DC that's been on the market for almost 6 months. And traditionally, that property rented in a matter of days. And it's just a different market right now. Much like the sale market, it's not the time to push prices high on rentals, because we all know the cost of vacancy is very high.
Mm-hmm. Yeah. So then, I think that from the Montgomery perspective, maybe something that we can check is just get into the Montgomery County, how we have been doing it, and check the different zip codes on where listings, where like more demand, what is the return on investment that you're looking for, what is the cap, all of that. And then we can just check and then just share and play with the numbers to see where, that investment is going to make sense for you, where the demand is there. I know that with Real Scout, with one of our tools that we have in the company, we can check, the demand, we can check how hot is the area, how much people is interested in the area, and also with different numbers, we can check into that. So we are not expecting that we're going to have like a very high price. And that was the reason why I shared them up in the beginning of the presentation. But anyway, I mean, there is opportunity, especially in the Montgomery County area, and it just depends on the type of property and the return on investment that you will be looking for. So we can check on that information for sure.
Lida, I saw there was a question about a forecast for the Anacostia area.
Yes.
I honestly don't remember what our numbers are indicating off the top of my head. So Lida, can I impose on you to get a better answer to that question based on absorption rates and that kind of stuff as well too? Because we do break that out on a very specific geographic and price range area.
Yeah, so then for the Anacostia area, probably we have to get like into deep into that zip code to see, I mean, what is the forecast on, I mean, what is the expectation? Of course, that is an area that is an upcoming area, and things have been like building. There is like from a building perspective also, there is like opportunity as what happened like in Trinidad. I mean, similar, let's say, behavior of the market. However, I mean, it's better that we just check that into detail,
Yep.
right, David? Yeah.
I need to do that off the top of my head.
Yeah. So, I mean, I know that pretty much recently what I have seen is that, I mean, there is a lot. I mean, there were like initial investors, like pretty much what I remember, like almost like 10 years ago. And then things have changed there. And probably what we can do is that we can check that into detail. What are like the numbers, how the market is behaving, and then I can give you like a more accurate information on that. So I think that I know that it's a precious morning for you, all of you. So I just wanted to share that our next event is going to be an investor workshop. So we're going to check into different numbers. We're also going to share like cash flow. We're going to talk about like flex assets at the same time, like Airbnb, rental, what are the rental incomes that we are expecting. So for all of you that you are thinking on investing at the same time, how you're going to use the equity that you have in your property right now to make this investment, I would love to see you in our next event. So save the date, is going to be on March 22nd. We're going to have one of our other experts that I'm going to share more information about it, but just stay tuned. I mean, I will be sharing information more about this event in the couple of days. So as we finish, I just wanted to say thank you to David for joining me this morning.
My pleasure, Lida. Thank you.
It has been wonderful to have you with us today, to sharing like all of this information, also to get your, I mean, insights, and also for you to share this information, which I know is something that the team puts a lot of time into it, and also that we have the opportunity to share this with our clients is very important for us. So thank you again for joining me this morning.
Thanks, Lida. Thanks, everybody.
And then thank you everyone for joining me today. Have a wonderful rest of the weekend. And if you, for the ones that doesn't get my information yet, so here it is my information if you want to contact us, if you want to schedule a follow-up consultation or anything regarding that. And we look forward to talking to you. Have a wonderful weekend, and I hope this presentation and information was very important and also got a lot of insights for you. So thanks again, and have a nice rest of week. We will be in touch. We will be providing you information on how this market is going to be evolving for the next days. Thank you. Bye-bye.